In this video, I want to bring your attention to AT&T and Microsoft. Now, you may have heard the news that they have joined forces, and I'm going to give you just a little bit of a history on the news of what's going on. Early on Wednesday, Microsoft signed a multi-year deal to offer cloud computing services to AT&T. Microsoft will be AT&T's preferred cloud provider for non-network applications. AT&T plans to become a public cloud-first company by migrating most non-network workloads to the public cloud by 2024. This deal is worth more than $2 billion. That's with a B, $2 billion. All right, so Microsoft and AT&T are jumping into bed together, and AT&T is buying from Microsoft. Now, generally when this type of an agreement occurs, AT&T stock would fall, right, because they're the ones spending the money, and Microsoft stock would rise because they're the ones receiving the money. So let's take a look at this, these two markets, these two charts, and see how they're working out today. Now, we also want to take into consideration some additional fundamentals, and I'm going to show you some of that, and we're going to also look at some additional technicals, and then we're going to decide whether it's time to buy or not, and when a buy signal is occurring so that we can take advantage of these moves in the market. And we also need to take a look at the broader market to determine what the broader market's doing, because these stocks will definitely be affected by the overall broader market. So we want to do a little fundamental analysis first, but this is AT&T, and then we're going to do, of course, I don't want to skip the technical side because we got to remember these are all fundamental information. Fundamental drives the long-term trend of the chart of the market, but it's the technicals that give us the entry and exit points. Okay, so we have to use the technicals in combination with the fundamentals. So let's first come over here and let's look at Microsoft. So this is the AT&T stock. This is Microsoft. And although they said that Microsoft stock rose, and that would be the traditional occurrence of receiving a $2 billion contract, it only rose slightly. And now it's falling and it's down today. So we need to take into consideration the broader market again. We also need to be taking into consideration the technicals here. And we also need to be taking into the market what the hedge funds and the activities that the big guys are doing. Where are the big monies coming from? Because it's the big money that moves these markets. All right, where are the big money? Where is the big money putting their funds? Now, think about the stock market. Every 2 weeks, we get a great big huge influx of everybody. You know, it's almost every 2 weeks. There are a lot of companies that do it on a 30-day time frame, but most companies do payroll every 2 weeks. And so they pull out the money from the IRAs and the the simple IRAs, the 401ks, and all that kind of stuff, and they send that off to Wall Street, and Wall Street puts it into the stock market. Every 2 weeks, it gets a huge influx from payroll, and these big hedge funds are putting it into the market. Where are they putting it? Where are they putting that money? Because that's what we want to know. We want to know where the big boys are putting their money. Now, they love stocks that have dividends. And so we want to make sure that we're following stocks that have dividends if we want to do what they're doing. We want to build a portfolio for retirement. You know, there's different strategies. There's different things you can do. You can day trade. You can build portfolios for retirement. You can just, build portfolios for intrinsic value. You know, all the lots of different strategies, and we cover all those. And we talk about those over time as we go through these videos and talk about the different markets and go through the video lessons. But nonetheless, we can't cover all of that in one video, but the fact of the matter is we want to be looking where the big hedge funds are trying to put their money. So let's do a little fundamental analysis on a couple of these, on these two markets, all right, should we? And, of course, my favorite fundamental analysis tool, if I can get it to come down here on the screen, my favorite fundamental analysis tool is TipRanks. And we're going to come in here, and I'm going to pull up MSFT, and we can see in here this is MSFT Analyst Ratings. All right, so this is what the big analysts on Wall Street are telling us that these markets, or what this market in particular is doing. Now, I want to say, if you've not heard of TipRanks is we're kind of associated with them in some way, in some degree. So they do give us a coupon code for you if you're interested in subscribing to their service. I have a subscription service, and believe it or not, I didn't even get to use the code, so I actually paid the full amount. But you can get a 25% off, and here's the coupon code if you're interested in subscribing to TipRanks. It's EDU19. All right, EDU19, and that'll get you 25% off of their service. I need to always mention that because a lot of people like to have some of these research tools that I use, and this is my primary fundamental research tool from TipRanks. All right, and they've given us a 25% coupon code for any of you guys, any of my students. That's why it's EDU 19. Any of my students are able to get that discount. So anyway, what's going on over here is we want to look at the analyst rating. All right, and the analysts are giving us 3 points. So this is a typical analyst type of a rating. They're going to say on the high side, we're going to expect it to be at 160. On the low side, we're going to be at 90. So we as individual investors are going, well, what does that mean to me? So we need to look around and we need to do a little bit of our own work as well, not just looking at what the analysts are saying, because it's their opinions are, they've got pretty good track records, but it's still, they have oftentimes you have to remember that they're working on a much different scale than we are. They're managing, huge multi-million, multi-billion-dollar hedge funds, and we're dealing with our own individual little retirement account. So this is coming down to the quantities of what we got. They're saying that, there's 21 of them saying that this is in a buy mode, strong buy. And then we have one that says hold and one that says sell. So, but they've also got some different projections on here on where they anticipate this market going out into the future. So that's kind of analysis here with these guys. We've got some nice strong buys on Microsoft. Individual investors we don't care about. Financial bloggers we don't really care about. Corporate insiders. This is nice because this tells you, if the insiders are buying or holding or selling, but you don't really know their intent and why they're doing what they're doing. But it's nice to know, though. It's a good report, and we'll look through it in greater detail on occasion. News and sentiment, of course, this is where we come in and find out how much news is being reported about a stock, which is very important, especially when we're looking at IPOs, right? Because IPOs, we want to have lots of people looking at IPOs because hedge funds and mutual funds, they don't generally get invested into early IPOs very often. They're more of a traditional type of investor, and they're looking for these great big companies, safe haven type companies that build equity and over a long period of time and are stable and aren't going to lose people's 401ks with a lot of radical moves. And they of course want stocks that are going to be giving dividends and all that kind of stuff. They're not usually as interested in the IPOs. So the IPOs are driven primarily by guys like you and me, the retail traders out here who get an excitement about a new company and want to be a part of that. And so we're the ones who kind of push that. And the way that gets done is through the news media, right? If there's a lot of positive information out there about what's going on, then we can come and find that in the news media. Of course, it's not that, the individual investors don't move big companies like Microsoft too. They certainly do. But that's just a little bit of insight into news and sentiment, and that's why this is such an important report for us. So we've got different types of news. We got bullish news and bearish news, and 94% of news on Microsoft right now that's out is very positive. 6% is bearish. Now we got to also remember tomorrow, or actually today, after the market closes, Microsoft gives their earnings. So we got an earnings report coming out here with Microsoft, and we'll go in and look at the charts and see if we want to play against that earnings report as well. So now let's come down here where this is the big one. This is the hedge funds. This is what we want to look at. Now the problem with this is that the hedge funds have been decreasing their holdings over the last. The blue chart are the hedge funds, and the black line is the underlying price of Microsoft. So Microsoft stock has actually been climbing even though the hedge funds have been a little bit bearish on this market. They've been pulling their money out. Look, they've decreased their holdings in Microsoft by 17.2 million shares in the last quarter. So that's like, why are you guys pulling your money out if, we got some positive information on Microsoft? What do they know that we don't know? What do they know that we don't know? They're very negative. They're very negative on Microsoft. So we need to take that into consideration when we're looking at Microsoft. So now let's go look at the Microsoft chart, given that little bit of insight. Microsoft, and they've been pulling their money out, and look what's happened here. Now, you think that the big hedge funds don't look at the technicals? That's not true. They definitely are looking at the technicals. But they use the technicals to help them understand entry and exit points and, the movement of the market. They are the ones who drive the market. Therefore, they are looking at the technicals. I can guarantee it. I've been to the Chicago Board of Trade, taught in the education center there with some guys who run some great big huge funds, and they will definitely tell you they are looking at the technical side of the market, and they understand and they know what Elliott waves are, they know what Fibonacci rulers are, they know what these projections and retracements are. So that's why we as individual traders need to learn this stuff ourselves so that we know what they're seeing and what they're thinking. I mean, we want to know as much about what they're doing with their billions of dollars as we possibly can. And so that's why trend lines, areas of support and resistance, and of course the fundamentals are important to us. So I just want to come through and analyze this market very quickly from a technical standpoint and show you a little bit of what I'm seeing in here. We come in here and we're going to draw this left shoulder, this head, this neckline, or this neckline, and then the right shoulder down here. This brought us a nice neckline break down here at the bottom of this lower trend. And you can see that blue light system, which is, the blue light comes from the bulls and bears. And the bulls and bears is a plug-in, of course, to the software into track and trade that turns the price bars red, yellow, and green. It gives us these Elliott wave trend lines. So you can see the breaking of the trend line right there with the blue light, which corresponds with that neckline of the head and shoulders formation. So that's where we kind of got a strong indication that the market was changing direction and becoming bullish. This is what that all meant for us. And again, I can guarantee you that the hedge funds saw this. All right. And as we come in here and we see this, now we have a nice 3-drive pattern. This is the Elliott wave 3-drive pattern, drive 1, drive 2, and then of course we come in here with drive 3, and then these are our little crossovers, the breaking of those trend lines, and giving us that information. Now obviously if you don't have the bulls and bears, it's very difficult to see this. You can turn the bulls and bears off, and as you can see, it's very difficult to know what's going on with this market. Turning on the bulls and bears in track and trade, again, as I always say, it's like turning on the lights in a dark room. So now we can see the patterns, we can see the bullish trends, we can see where the market's changing from bullish to bearish to neutral. Again, the yellow is the neutral zone, and the bulls and bears all calculated based on Fibonacci, and those yellow dots, or those yellow bars are the market going through. Are going through the Fibonacci sequence. So going through the Fibonacci neutral zone. All right, so as we come up through this nice big long bullish trend, we get to the top of the third wave, which is very common with the Elliott wave. If we come in here with our little Elliott wave tool, you can see that we started, this is the head and shoulders formation, so this is X, 1, 2, 3. We get 4 right in here, the breaking those blue lights. This would be 5. We have A, B, C. You can start it down there at the head, or generally we'll oftentimes start it right here off this first leg. So this is X, 1, 2, 3, 4, 5, A, B, C. This is just kind of a nice little Elliott wave in there. Of course, we can turn on the computer's Elliott wave auto zigzag tool, and it will come in here if we want to spend the time to draw that out for us and make those calculations with those Fibonacci calculations. But once you get good at identifying those and seeing those using the bulls and bears, you can use the zigzag if you want to or not. I can just visualize these using the bulls and bears, and that's why I don't oftentimes turn on the zigzag, because I can see it in the bulls and bears. So these calculations, if I want to see the calculations, I can come back and measure in there, and we can do that little type of measurement. See the market rallied up on this first leg, or second leg, pulled back into the Fibonacci sweet spot, rallied again, and we can measure each one of those legs individually if we want to. And that's how this world of technical analysis works. Okay, so we're going to come in here, and again, we're going to draw our trend line across there. You can see we got the area of resistance coming across the top of these bars, coming into a crossover at the same spot as the blue lights. We always want to have our trend lines match the blue light. This is a breaking. The market started to rally once again. So what are we seeing now? Okay, and that's all the history, just to kind of prove a little bit about how this technical analysis stuff works. Again, we have to realize that technical analysis is not perfect. It's not going to do the same thing every single time. It's just probabilities based on the fundamentals and what we've seen in the past. When markets move through certain wave patterns, we anticipate them to continue through areas of support and resistance through price and time. So now as we come through there, and we're going to draw our trend line back up through there one more time, we can just draw that trend line in there again, make sure we kind of corresponding with those blue lights and where they're at. You can see the breaking going from the green to the yellow. And that's right up here where this market broke. So then you ask yourself, well, the hedge funds have been pulling their money out. Is this why this market's going to fall? They're not very bearish on this market. They're as it says in the hedge fund list here, they're very negative actually. But they just won a $2 billion contract with AT&T, right? So what are we going to do with this Microsoft contract? Now, before we jump in and start making trades on it and saying, well, what are we going to do? Because this is actually a sell signal, right? This is actually a sell signal. We crossed over that trend line through the yellow lines. That's a breaking of the trend line to a bearish side. Do we want to be buying a put option in here? Are we bearish enough on the market that we think it might be falling to a significant degree with the fact that they just won a $2 billion account? Do we want to be taking a short position, or do we think this is just going to be a small profit-taking pullback and then rally once again? And rally once again, or do we think that we want to take a look at a little bit more information? Let's come out and look at the broader charts of the broader market. Okay, let's come out and look at the. I want to look at the S&P at this point. This is the S&P, and you can see we're long 13 contracts in here. We're down $669 on this market. The S&P, we were. We got some. We actually did a call and a put in here. We made some money on the put as this thing started to come back, but then we liquidated that put position as we broke across, and now the market's coming back down. We're losing money on our calls on the S&P. So we have to decide what we're going to do. We're down $689 on this particular position with these options. We got 64 days left to go. Let's draw our trend line in here, and the question has to come in here: do we think this is the big sell-off that everybody's been predicting? Everybody's been predicting that the market's going to fall really hard in here, and this is one of the reasons why all the technicals are indicating that the market's going to fall. And then when you have something like this, where you say all the hedge funds have been pulling their money out of these big markets and are very negative on a long position, it has to make you wonder if there's something else going on, and whether everybody's anticipating a pullback like this. Now, we will, of course. We'll go look at AT&T here in just a minute and do kind of basically the same analysis on AT&T and see if the hedge funds have been doing that over there. But this is kind of our three-drive pattern on the longer-term trend. If you take a look at this, this is drive 1, right? This is drive 2, right? And this is our drive 3. So we got drive 3 in here. We're at the top of a drive 3. So do we want to be buyers at the top of a drive 3? No, of course not. That's the top of an Elliott wave pattern. We don't generally want to be buyers up there. Now, we've got long positions on here with this market breaking and going short. The question is, we've got 64 days. Do we want to hang on to this in anticipation of the possibility that the market might just pull back and then turn around and rally once again? Well, I don't want to take that risk, so let's just come in here, liquidate. We're going to liquidate all of these. Just take them off the table right now. Cut our losers short, let our winners run. We didn't really make anything off of that thing. That was kind of a scratch trade at best. We made a little bit on the put when we liquidated it, but not really, because it came back against us, and we had to get rid of it before it started losing money. And then the options started to rally. It went up there, and time kind of just took it away, and then not really a good position. I wasn't real pleased with that position anyway. I want to be getting in on these arrows and these breaking of these trend lines. So this is actually should be a short position. We should be picking up a call option. But I'm not really anxious to be going short against the market either right now. So we're going to have to wait and see. But this is the S&P, and I might be picking up some additional. We're definitely at a decision point. We could come in here with some options, and we could pick up a strangle or a straddle. And I might do that. I have to do a little bit more analysis, decide what I want to do. I'm right now focused and concentrating on AT&T and Microsoft. This is the broader market. This is something I want to be aware of, where we're at. Things look like they need to fall and pull back and make a retracement. I just don't know how far. Okay, so if we do the shorter term time frame, we just draw a trend line in there for the broader market and say the market should come back somewhere into this 50% level, right? But we could also have just a little pullback like this. Nothing says we have to have a big major pullback. We could definitely get a rally, a break here. This is definitely a pullback. We're there. We're there. It's happened. We broke the trend line. It's just how far is it going to fall back? Well, traditionally speaking, it comes back into the sweet spot and then starts to rally once again. So that's kind of where we're at with the S&P and in our anticipation. Now, the fundamentals overall broader market, the U.S. economy is still doing really well. We're above 3% on the GDP. Big companies are making money. They're all happy. Why this market would pull back, there's really no reason to see that. Other than the fact that we got a little bit of problem going on with China and the tariffs, but that's not really been affecting the overall broader market anyway. You can see that we've had these China talks clear back into December, and that the market's done nothing but break all-time new highs through that entire talk. So how much is that really affecting us? The other thing is that the Feds said that they were going to lower interest rates, and they kind of made that. They first, right in here, they said they weren't going to lower interest rates. Then they said they were going to lower interest rates, and the market started to rally once again. So now the market started to come up here and rally, break all-time new highs, multiple times in a row. And now they're starting to, you hear the rumor that, well, maybe we won't raise interest rates again. We'll just kind of hold them where they're at. You have to ask, the question has to be asked, how high, how hot does the market have to get before they raise the interest rates, lower the interest rates? And that's the big question. That's why whenever those guys speak, we all jump. So this is a rally that came from them saying, hey, there's a possibility we could lower interest rates after all, because the market started to fall when they said that they were going to raise interest rates, and then it started to rally once again. So now when the market was trading right here, they said it's too hot, too far, too fast, and we need to raise interest rates to slow things down. Well, what do you think they're thinking about right now? If this was too hot, too far, too fast, and we need to slow things down, let's say we're going to raise interest rates, well, then the market fell, and then they're like, oh, maybe we shouldn't have said that, and now it's back up here. Now what do you think they're thinking? I don't know. They said that they might lower interest rates, but with the market up that high, they might not do it. Well, if that's the case, and they're thinking they're not going to do it, then the market might fall again. So that's kind of some of the thinking that's going on in the overall broader market. So given that information, and I want to do one more thing for you. I got to do it. I can't stop myself. I know this video is getting a little long, but hopefully you're interested in this and we can go and talk about this stuff. For me, this is like, I just love it. I can talk about it all day long. So here we come in here and look at this. This is our Fibonacci time sequence. I'm going to put those 144 days right there on the bottom on that peak. You can see we came in here with a nice little decision point right there around the 89th day. The 55th day came in here at this peak. We came in here at the 34th day at that low. This market started to rally. We had a little break and peak right in here around the 31st day. Now look where we're at. We're coming into this big sequence right up in here. So this is, to me, a really important time frame, and I've been kind of waiting for this to happen, and I've talked about it in multiple videos, and you can see these blue dots coming up in here, and this market coming up in there, and we're coming up to this big decision point right here. And what's supposed to happen at this big decision point? Well, based on the movement of the market, right? If we draw our zigzag in there, or we draw our X, we'd go up, down, up, down, up, down. All right, so something's supposed to happen right in here based on Fibonacci, and this market's been pretty good on the Fibonacci sequence. It's been following it pretty much like a train on rails. And again, if you think that those big hedge funds, they don't have that little calculator ruler, you're dreaming, because they definitely have those big hedge funds have that ruler. Where do you think I got it from? All right, where do you think we got that ruler from in the first place? You think I made it up? No, I didn't make that up. These big boys have this stuff. All right, and they do their timing just like we do. And the reason we do our timing is because they do. And so we want to follow what the big money's doing. And hey, this is what it looks like things are happening. X 1, 2, 3, 4, 5, ABC 1, 2, 3, and this market's getting ready to fall. So we just want to bring that to your attention. So back to the original story, back to Microsoft. Let's start back here to Microsoft. What are we going to do? This market broke, and we're going to do the same thing. We're going to come in here with our Fibonacci timeline. We're going to drive that in there, and we should get something relatively similar, right, to the overall broader market. This is one of the big players in the S&P. And we're going to come up here, and where are we at? We got our, let's put this right on the bottom. So we're right on the bottom here with the 144th day. We got our rally points, our turning points at 55, another turning point at 34, another turning point at 21. We're right back up in here, 5 days. We're starting to get really nervous, all right? So in my opinion, this is nerves coming into this closing point, and that's what we're looking at. We're seeing people are getting really nervous about this market continuing to rise higher based on the overall longer term patterns of these technicals and the fundamentals. But the fundamentals are strong. That's what's the problem. Why are these markets falling if the fundamentals are strong? If the fundamentals are strong and the markets are starting to fall, the broader market is starting to fall, you have to ask yourself why. The underlying fundamentals are strong. 3.5, 3.2 GDP. We got, we got no wars or rumors of wars. We haven't gone over and beat up on Iran this week or last week. They've been pretty quiet, since we had that little kerfuffle a little while ago. China's been quiet in the negotiations over there. The only thing we've been having is just, the typical Republican versus Democrats. We hate you, they hate us, can't get along. But, in my entire lifetime, when has that not been happening? Yes, but of course it's a little ramped up right now. But nonetheless, politics don't drive the stock market all that much. Now, it doesn't say they don't. They definitely do, but not all that much. I mean, the presidents can move the market a little bit with a few words, but for the most part, Congress and they can't really move the market all that much with all their rhetoric. There's too many of them that can say positive, negative things against one way or the other. Nonetheless, we try to be objective when we're looking at our politics in the markets. We don't want to take sides, because all we're really interested in finding out what's going to move the market and what's going to make us money. And that's the real crux of the entire political world for us. So try and stay neutral when it comes to politics. Think about it neutrally. Don't get emotionally involved, because you get your emotions involved in the stock market, you start making bad decisions based on emotion. And you see it in the news all the time. And I have to point this out. CNN is very biased. And so if you watch the CNN news, everything is always negative, and the stock market is always going to fall, and everything is bad. So, and they tie that to the politics. So you have to be really careful with the news sources that you pick as well, which is, why I love this software from TipRanks, because we can come in here and we can look at the news sentiment, and we can see all the news sources, whether they're bullish or bearish on the market. So we can kind of look at them from an overall standpoint without, taking personal biases into consideration. All right, so there's Microsoft, and it's falling. We could take a put. We could take a short position with some puts, but we haven't even started to talk about AT&T. So now we have to come over and look at AT&T. And the first thing we want to do, of course, is, and we're running close here. This video is getting a little long. I want to kind of wrap it up, so we'll go through AT&T very quickly. This is kind of where the analysts are. They're saying we got 5 buys, 2 holds, and no sales. They're anticipating, you can see their projections, higher, even, or lower, whatever. That doesn't really help us. So we don't care about individual investors, financial bloggers, corporate insiders. Again, I'm more interested in the interest of time, to look at the hedge funds. We'll jump right down here to hedge funds. And they have been decreasing their holdings by 4 million shares last quarter. So they dropped really hard and started to dump their shares out of AT&T as well, which of course shows them as being very negative. So we have to be careful, because the big money is coming out, and it's generally the big money that pushes the markets higher. So if the big money is coming out of both Microsoft and out of AT&T, and they just did this $2 billion deal, moved $2 billion over from AT&T, and it's over the next 2 years. So they're going to dump $2 billion out of their coffers today and into Microsoft's today. It's kind of going to be spread out over time. And we have Microsoft coming out with their earnings, and of course none of that money is going to be reported in the earnings, because this is their earnings for the last quarter. This is going to be coming up. We have to take that into consideration as well. What are we going to do? Here's AT&T, and they're falling. If we come in here and draw our trend line, you can see that's this big trend line comes in right underneath all this areas of support, and that blue light kind of drifted a little sideways because of the sideways trend here, and then the market started to rally, in which pulled. You can see the dots extended, and it started to pull that up there as we started to come into a crossover. And notice how it crossed over just almost perfectly right there. This is a great little sell signal right there, and down this market went. You can see that repeated over and over and over again as this market kind of rallied and then pulled back, and then rallied and pulled back, and then rallied and pulled back. Now, if we're trying to build a long-term portfolio, and we're trying to go for strong stocks that have good dividends on them, and we're building a retirement portfolio, AT&T is definitely something we're going to want to have in our long-term portfolio. But the thing I hate worst of anything at all, the one thing I really hate is when you get into a market and the very first thing you start losing money. You're like, I'm going to buy AT&T because they're a really strong company and they're going to be around, clear into my retirement, no problem. I can trust my money with AT&T. And you put your money in there, and the first thing that happens is you just watch for the next 3 months, watch the money, watch your position die. There's nothing worse than that, and I hate that. And I try my very best to show people that, you need to buy the valleys and sell the rallies. I know you're going to stay in this market for 20 years, 10 years, 15, 20, 30 years. You're looking for the long-term haul. But nobody likes to put their money into a stock only to see the very first, right after they buy it, that it falls and tanks. The problem with that is people don't like to buy markets that are doing poorly. They like to buy markets that are doing well. Well, when is that happening? There's when a market's doing well. Here's when a market's doing well. Here's when the market's doing well. Here's another spot when the market's doing really well. Here's another spot when the market's doing really well. Well, where did most retail traders buy into the market? They bought into the market at each one of these points where the market's doing well. They want to buy a market that's doing well. They don't want to buy a market that's doing poorly. So they bought all of these peaks, and then, of course, as soon as they buy it, the market drops, and all the traders take their money. So all the other traders who were taking short positions took their money. So don't buy a market that's doing well. And that's the name of the game. Buy the valleys and sell the rallies. We don't want to be buyers at the top of a green trend. Well, you're like, well, how do I know the green trend is going to end? Well, look at the intercepts of the blue lights. The blue lights are going to intercept that green trend, and when they do, the market generally falls. Market starts to rally, the intercepts with the blue, the market falls. Market starts to rally, intercepts with the blue dots, and the market starts to fall. That track and trade bulls and bears indicator is, again, I can't say it often enough. It's like turning the lights on in a dark room. So we want to buy in the valleys and sell the rallies. So we want to time our entry points, and if we're trying to get into this market for the long haul, and we're trying to go for, years and years and years and years of holding a position. Granted, if you bought it at one of these peaks and it fell back and you lost, 20, 30% of your investment, and then it came back for you and rallied and started to come back again, you're going to be okay in 3 months. But man alive, that nothing, dashes your hopes of being a trader, of buying into a stock that's doing well only to have it fall and lose 20, 30% right off the bat. And then you're like, then you're shy, then you're scared, then you're like, oh, this stock market thing is scary. But if you got the right tools, you learn just a little bit of skills, technical analysis. Some of these tools can help you know how these hedge funds are working. It can save you a lot of stress and aggravation. You know which stocks are providing dividends. You want to get these dividends from long-term stocks. But the thing about dividends is they will not pay for a fall in the market. Dividends are just like a little icing on the cake. The stock increasing in value is the cake itself. And you don't want to just sit around trying to, scoop cream off the top of the cake and think that you can live on icing. You can't. So remember, stocks have two types of value. They have intrinsic value and they have extrinsic value. All right, the extrinsic value, or the value, is basically like what we talk about in options. You hear me say that in options, but a stock has intrinsic value, which is how much the stock increases in value from this point here to this point here, right? And if we come in here and let's turn that to percentages, it's a 27% increase from this low to this high. Now that's intrinsic value. Now over that time frame, 1, 2, 3, 4, 5, 6, 7 months, maybe maybe AT&T paid out some dividends, and they probably paid out what? 1.5%, 2%, maybe 3%. Some of these companies will get up into 4 or 5%, but usually if they're paying out above 5% in their dividends, that's because the stock is falling. Okay, and so their dividends go up because dividends are calculated on a basis. They use the stock in their calculation. Therefore, if the stock falls, the stock price falls, that increases the value of the dividend. And so if you get a real high dividend, you're like, oh, wow, I want to get that company. They're paying out a 10% dividend. Well, that's because of probably the intrinsic value on the stock is tanking. It's probably falling through the floor, and that forces their dividend dollar amount up, and they're kind of incentivizing you, saying, hey, our stock is falling through the floor. We'll pay a higher dividend if you'll hang on to it. But don't do that. Don't fall for that. You want to buy the valleys and sell the rallies. And if a stock is losing 27% of its value, a 3 to 4% dividend is not going to help. Okay, bail out. Dividend is secondary. Okay, so we don't want to be trying to stay into a market for in hopes of getting our money back in 10 years. How old are you? Do you want to wait 10 years to get 20%? No, just get out. That's why we use stops, and we don't want to let our once we get in, we don't want to take big losses. We don't want to take the intrinsic value. A lot of people have that in their head. They're like, well, I don't mind if I lose some money when I first get in because I'll gain it all in my dividends. No, you won't. No. Maybe in the future, maybe if but are you willing to sit through a 20-30% drop in your stock value to pick up a 1 or 2% dividend? The logic isn't there. It's not sensical. So let's be strategic about our entry into the markets. Let's pick stocks if we're going to try and hang on to them a long period of time. Let's pick stocks that have nice dividends, and then let's buy them in the valleys. Okay? Don't buy a stock that's doing well. Buy a stock that's been doing poorly and starting to round out the bottom. These are the time frames. These are the areas that you want to be getting into these stocks down here, all right? Not up here when the stock's doing well, and it's a big problem that a lot of new traders do. They want to buy stocks that are doing well, and they buy at the top of these big green trends. Okay, I've rattled on long enough. This is AT&T. It's starting to fall. What we're going to be looking for is we're going to be looking for the market to pull back, and then we're going to be looking for one of these valleys, one of these arrows, one of these valleys, change over from red. It hasn't turned to red yet. It's still yellow. It's still in the neutral zone. We don't know what this bar is going to be, whether it's going to turn red or if it's still yellow. But as this market falls, we're going to look for the market to turn around and start to rally once again. We're going to start looking for the hedge funds to start increasing their positions into the markets. But you know what? By the time we find out whether the hedge funds are increasing or decreasing their holdings, it's already too late. Market's already doing well because they've started to move the money in, and then we get reported and we find out, but the market's already started to rally. So we need to watch these technicals. That's why the technicals are so important for us as small speculators. We need to be able to watch those trend lines and those speculations, make those speculative turns, and we put our money in there, and if the market goes against us, we just get right back out. All right, we don't take big risks. We wait, and we can do it again, right? We get another signal, we go ahead and we put our money in there, and we do it again. And we don't have to put all of our money at once. That's another fallacy. A lot of people, I'm going to get into AT&T, and I want to put 25% of my holdings into AT&T, and so they dump 25% of their holdings into AT&T, and then AT&T falls, and then they're like, oh crap, I'm losing 25% of my money on which is 25% of my whole portfolio. No, we start off with small positions. We call them test trades, test positions, and we put test trades in. And I've gone on and on and on, and I'm so many things I want to tell you guys. So that's just my quick take on AT&T and Microsoft. There's no buy right now unless you want to try and take a short position, but I am actually just looking for the opportunity to get into a long position on a pullback, and that's exactly what we need. We need that to happen. We need a pullback to come in, to occur. We need the market to turn around, start to rally once again, gives us an opportunity to put some money into this market and watch it go again. All right, so that's AT&T and Microsoft, a little bit of news and where they're going. And of course, if you would give me a like, share, and ring that little bell, make sure you subscribe to our channel and hit that like button if you like this video, and I'll do more like it. If you like little shorter videos, don't hit that like button. But if you like me to go into some great detail like this and spend a little bit of time with you and talk a little bit about the markets, go ahead and hit that like button. Share it with your buddies. That would be great too. I'd appreciate that. That'll help get the word out. We can do more of this. Hit that bell, because if you don't want to miss my next video, you got to hit the bell. All right, guys, subscribe, and we'll see you next time.